Hi, and welcome to this edition of the Coronavirus Freight Market Update. My name's Kevin Hill, joined here with Michael Vincent.
Welcome, everybody. This is our twice-weekly coronavirus freight news and market condition-focused interactive show where we invite viewers and those of you self-quarantined, working from home, to get answers on the COVID-19 impact on our industry. And we're happy to answer any of your questions on FreightWaves, LinkedIn, and on Facebook. Right?
Facebook and
Kevin
LinkedIn.
will be monitoring those. And we'll get to those comments. So
send us your questions and comments, and we'll read them and try to answer them the best we can here on air. But here we are, April 23rd, 2020, in the middle of the coronavirus epidemic.
Yeah.
And
who do
what
we
are
got
the
on
numbers
today?
these weeks?
Who do we got on today?
Today we have Andrew Cox, who will start with the news. We'll go over the headlines. We have some meat packing plants that are having issues with contagion. And then Zach Strickland, our director of Freight Market Intelligence, will come on and talk about earnings and the freight market. And then our head economist, Anthony Smith, will talk about some economic numbers that are dropping right now and hitting the news wires. And then we have Andy Berke, who will be joining us via
today,
Skype.
calling in,
and he's with Blue Grace. He's the principal and senior director of strategic ventures. And then we'll talk about what SONAR is telling us about the freight markets right now, and then we'll end the show with a high note and a wrap up of FreightWaves.
Yeah, what we're seeing
TV.
in SONAR.
TV. What we're seeing, So
excellent. So let's go through the numbers here. What is today? Thursday. So on Tuesday, the count was at 792,938. That's U.S. in cases, and now we are at 848,717. Deaths were at 42,518 on Tuesday, and now we're at 47,684, rapidly reaching that what they are calling the top end. Which, when we started this, we were at 6,344. So and 110 deaths. So 6,344 cases and 110 deaths, and now we're nearing we're getting darn near 1 million cases and close to 50,000 deaths. So it's been a grim road. According to the IHME, the Institute for Health and Evaluation at University of Washington, what we were looking at before, the peak had appeared to be on the 15th, as we spoke about on Tuesday, and it hit at 2,618. But the 21st, which was just a couple days ago, it was at 2804.
Yes.
So there was a new peak, and the projected was at 2151. Was the projection at first? Now the peak was just 2 days ago at 28. Much like freight volumes, we're talking about freight volumes. Did it hit the bottom? Are we bouncing along the bottom? How far can it go? It seems like predicting the top of this in the back half is a little difficult, yeah?
Yeah, so flattening the curve, I think, with that peak or apex, it's going to be elongated, right?
It's going to bounce along up and down.
Along a peak before you see a noticeable event that will drop the numbers over time. But we're going to have a long apex or curve is what we're experiencing right now.
And I think some of it, when you look at it and you dig in the numbers, and we don't go through all those numbers, but you see the hospitalizations are still coming down. We're on the backside of that.
Which
so these are
really
patients
good.
And stuff that are already in the hospital that are coming through there. And you do see recovery rate versus number of new cases tightening, which is a good move.
Probably the best leading indicator in this are hospitalizations.
Yeah. New cases coming in.
Yeah, because new cases, people testing positive, the testing is probably not there yet to have a really good indicator. But talking about cases and new COVID-19 cases in the food supply chain, meat processing plants, we have a great article on FreightWaves.com right now by Clarissa Haas, and Andrew Cox is over here in the studio to describe that for us.
Clarissa Haas. She's talking about the meat packing industry and the meat processing industry in the U.S. We've had over 12 closures of plants throughout the U.S. Almost every major food processor has been forced to shut down at least one of their factories because of COVID-19 contagion within their walls. Their employees are getting sick. Notably, Tyson Fresh Meats had to suspend its operation at a Waterloo, Iowa plant where nearly 200 workers contracted the coronavirus. And this is a massive meat plant. This singular plant goes through 4% of the pork production in the U.S. Each year. So these are not just little mom and pop shops that are shutting down. These are some of our major food processing plants in the U.S.
Yeah, the mom and pop shops are actually getting inundated. There's one in my neck of the woods that's been there. It's an icon in where I live, and that it's a local butcher shop, and just packed constantly.
Yeah, it's really a scary situation. Besides maybe the medical supply chain, in pharmaceutical supply chains, I can't think of a worse supply chain that could be damaged during this COVID-19 outbreak other than food processing. I mean, Americans eat a lot of meat. Each American eats around 230 pounds of meat each year. So to say that it's a stable part of our diet is a complete understatement. So having these processing plants closed is really scary about the future of eating over the next couple of weeks if this continues to be a problem.
Yeah, it's an interesting article. You really need to read it because there's other information in there, right? So there's 48 plants or something across the U.S.
Yeah, it's
what did it say? 2,200 workers, 2,200 workers in meat packing plants across the U.S. at 48 different plants tested positive.
Yeah, I saw in the article that this Tyson pork processing plant accounted for about 4% of the daily production. Smithfield Foods in South Dakota, Sioux Falls, was about the same number. So
right.
those are two huge chunks of the supply chain that is now offline and basically creating backups of certainly for trucking of transporting hogs to and product out of these plants.
Yeah, workers within the plants and drivers as well have said that they're kind of running out of options. There are mom and pop shops, like you said, Michael, that are doing well, but the big guys are hurting right now because they're finding it difficult to socially distance within their walls.
Yeah, and the backup of the animals, right? So the farms are having difficulties here as well. They're feeling stress.
Yeah, there's major kinks in the supply chain from production to consumption. I've seen a video on LinkedIn the other day of onion farmers in the Pacific Northwest where they're just throwing away millions and millions of pounds of onions because they don't have anywhere to put them. Even food banks won't take them. So this is a problem in not only onions, but pork and everywhere else. I mean, the supply chain is really out of loop right now.
Yeah, it's fragile. But in that article, there's some good stuff. You need it's a really good read, and it's interesting because it kind of shows you both things, and it shows how really the virus is kind of going through the meatpacking industry and how it's flowing, right? So the 2,200 at 48, but most of those remain open. There's only 12 that have closed, and Tyson's bringing one back up online in at Columbus Junction, I think it is. It's coming back online. It was closed like 2 weeks ago and coming back up.
And I think we're going to have a story out later this week, maybe tomorrow, about how the auto manufacturers are taking notes from this and studying it. And so we'll keep on top of this situation. Our next article is from John Kingston, and it's about the Transportation Intermediaries Association, or TIA. Had a webinar yesterday with Noel Perry, the trucking economist. And what did we learn from that, Andrew?
Yeah, Kevin, Noel Perry, the longtime industry economist and chief economist at TIA, in a sponsored webinar yesterday, said that he's expecting a major capacity crunch and a belt up of spot rates late in the year. But before then, I mean, he had a lot of things to say. Before then, he said that he doesn't believe that we'll reach pre-crisis volume levels until 2023 or 2024, and that rates are going to be terrible through the year. But he does expect a capacity crunch there at the end of the year because he's expecting a lot of drivers to park their trucks on the fence because they're just sick and tired of the bad rates and low volumes right now.
We've kind of seen that sentiment lately throughout the press, and down in Houston is very low rates, especially in the spot market for trucks. I'm sure that's a huge part of that, right, Andrew?
Yes, of course. I mean, we saw the Houston protest just this week. You're seeing a lot of tension between drivers and brokers, especially because of the tension that brokers are pushing down carrier rates. We've expected that spot rates would encroach upon those operating costs per mile for carriers. We're hearing that has already become the case from a lot of drivers all over the country. And there's really no encouragement that spot rates could band up anytime soon. His expectation is on his projection that 600,000 trucks, will be taken offline in the next 2 quarters. Seems like a big number, but that's what he's expecting to see this capacity crunch late in the year.
Yeah, well, Andrew, the numbers in SONAR certainly echo what he's saying if they stay the way they are right now, with rejection rates down at, 3.13%. I think it's the lowest it's ever been since the inception of the index back in March of 2018, and that would indicate that truckers are taking everything that they can get, right? I mean, so rates are severely depressed, and there's really. I guess it all depends on how quickly the economy comes back online and how successful we are at getting back to work, right? As to whether his predictions and observations come to fruition. But I really can't argue with what he's saying right now, especially with what we're seeing.
Yeah, I mean, volumes are going to continue to be low until the economy opens back up, and carriers are going to accept whatever load they can get at contracted rates until there's other options. And right now, there is no other options. So he mentioned in the article, or he mentioned in the webinar, that he believes that carriers are going to be accepting everything they can through the next 6 months, and we're seeing that right now in the outbound tender rejection index.
And David Forsey on Facebook says, I'm parked for 2 weeks and counting. So I guess he is parking his truck because of low rates, and that's really Noel's thesis, is that the low rates will drive carriers out of the market, and whenever freight volumes do pick up in the later half of the year, that there'll be a crunch as supply and demand adjusts itself as it does all the time in trucking. So
yeah, and one just a so when we talk about this, we talked about this the other day when I believe when Craig Fuller, our CEO, was on debating Zach. And we talked about the fact that there's people out there that are on unemployment, and getting them back to work is going to be difficult. So just because freight volumes come back, these guys that have parked their trucks, if they're on unemployment, those rates are going to have to hit a certain level before they bring that capacity back online, right?
It does, yes. Yeah. So basically, volumes have to recover enough for that capacity crunch to really hit. Yeah.
So even if there's a capacity available to come back online and people doing it, their willingness to do it and come back online for the rate, it's going to have to come up before that capacity comes back, which adds to the pressure a little bit, right?
Yeah, definitely. So we have Zach Strickland now, our director here at FreightWaves, our director of Freight Market Intelligence. And before we talk about earnings, I have a question for you from one of our viewers, and that's Emily Pappas from BNSF Logistics. Are we seeing any swing in produce markets?
No, we are not seeing any swing just yet. It's still a little early. We've been watching a little bit of activity out there in the Fresno market. But so far we haven't seen any real significant activity, but it is that time of year, so it's any day now.
Very good. So you're on today to talk about earnings. We're in full swing in earnings season right now. I think we had 7 major earnings releases just yesterday. What are earnings telling us about the trucking market, Zach?
So yeah, we've had several earnings this week. Knight Swift, of course, reported, along with Echo Global Logistics, on the brokerage end, and then we also had Landstar report, as well as Heartland. So everybody, we're really in the middle of it, and we're starting to see, a real significant trend develop here. Not a lot of, mostly volumes and revenues are showing down for the most part. Margins are getting compressed, but it's hard to discern just how much of that is actually related to the corona outbreak. A lot of these guys are talking about how their March was not that bad. Landstar even reported they didn't see any significant changes to their expectations until the last week of March, when volumes just fell off the board. So right now we're looking at a lot of contracted freight, which if you remember us talking about the Cass line haul index a few weeks ago, a lot of that stuff had already compressed. A lot of the rates had already compressed year over year, starting in January, as some of these bids became implemented first part of the year. So we've already seen a lot of rate contraction on the contracted end be implemented, which is probably what we're seeing most of in these earnings calls.
Yeah, that margin compression is pretty natural with the run-up in volumes, 30% above 2019 for the tender volumes in SONAR. What's the outlook for the second quarter, though? Because that's, we had the run-up in trucking, and then the volumes kind of flattened out and fell about the end of the third quarter, or end of the first quarter, I should say.
Yeah, I think most of them are staying away from any guidance for the second quarter, which obviously is a wise decision because either way, the volatility on the market right now is so high, they're probably not going to be close by any means, and obviously there's a lot of uncertainty going on right now. We are starting to see a little bit of a trend in terms of contracted freight volumes leveling out to an extent, but that has yet to be really actualized on what that means moving forward into May and whatnot. So,
well, that contraction, or that you're not seeing any change in rejections, right? I mean, even though it's kind of leveling off, the rejection rate is at an all-time low.
Yeah, we're at 3.14% on the tender rejection rate. Again, continues to go down. It can't go much lower. You can't go lower than zero. But that just also means that spot rates are just going to continue to compress as far as people will take them. But even that being said, I think a lot of people will talk about the brokers driving these rates down. But at the same time, we're talking about their margins being compressed, simultaneously. So it's not like they're really getting a huge benefit here. They're just really chomping at each other, trying to maintain as much capacity as possible. So Echo did mention that they had increased their contracted or managed freight transportation side from 52 to 59% of their overall business. So that means that they are less exposed to spot market fluctuations in that regard as well.
So we have a couple questions here from viewers, and the first one's from Travis Hamden at Condesa Freight, and it's really what's the percentage approximately? Was there any color on this on the earnings reports? What percentage approximately is moving freight through the spot market now? So, traditionally it's about 80-20, 85-15 mix between contract and spot. Did any of the trucking companies that have reported earnings, is there a shift in those percentages in the short term right now?
No, nobody specifically talked about their mixes changing in that regard, but I think that what I just said with Echo is pretty telling itself. I mean, that's a pretty tremendous switch or increase in contracted freight volume mix. The managed trans side going to 60% of their overall business is a pretty big number for a broker. I think that is probably something that you could apply forward to the Knight Swifts and the Heartlands, as they are, essentially using the spot market for, filler only at this point. Which
that would indicate that Echo is concerned that spot market rates have a ways to go down, right? They're trying to get the contracted rates and at least guarantee some sort of level. Is that right?
Yeah, for sure. I mean, you don't want to be, I think this is the year that you really don't want to be exposed to too much spot market activity. I know USA Truck is coming up on the earnings side, so that one will be interesting to see, because they have been, struggling here of late in the last couple of years and relied on the spot market heavily in 2018 to kind of prop themselves up, and they got a little exposed last year. So it'll be interesting to see what they have to say about things moving forward as well.
And we have a couple more questions from Ruby Berthollet from Ultimate Transportation. It kind of goes into the conversation with spot market rates. And we've kind of gone over a little bit, but specifically, why are the spot rates too small? Why are the spot market rates to small fleet owners so low on the main load boards like DAT and Truck Stop? She's in Texas. This is all over the place. Down in Houston, the protests. Claiming brokers are greedy and keeping money for themselves. She's an asset and a broker. But, spot rate environment. Can you go into a little bit more in depth about that?
Yeah, I mean, the spot market itself is going to be a product of how people are behaving on their contracted side. And when people are simply accepting more of their contracted freight, so carriers are able to, or maybe they're even going out of their way to make sure that they're servicing their existing customers. I mean, most of these carriers now are they were expecting the volumes to drop off a cliff, while it was peaking. So they were already considering rate decreases and all this kind of stuff beforehand. So these contracted rate decreases are going to put downward pressure on the spot market in this position also. And that's another thing to keep in mind. If you're talking about a 2 to 6% rate decrease on contracted freight, and then everybody's going to start to get a little bit more desperate, that's going to push those spot rate numbers down even further. And especially since it's spot market freight, you're talking already about a more desperate activity in itself. So those rates are going to pull lower faster than the contracted freight rates will in general, just like they're going to go higher faster when things get hotter.
So, Zach, just the relationship between the shipper and the carrier, between the contracted carriers, right? When freight goes soft, those shippers tend to take care of their core, right?
Correct.
And so we're kind of seeing that, aren't we? And that puts more pressure on it from both sides. The carriers are looking at freight levels dropping to historic lows, and therefore they're going to keep those, their big contracted people is, fed with volume or with capacity to handle every shipment they can get out of those. And said shipper, every sale is pretty important right now, and so they're going to go to their trusted and take care of those core carriers. So service and reliability of that capacity from their core carriers and what they're going to do when they come out of this is of greater importance than cost, no?
Absolutely. I mean, these shippers are not, they don't think about things in the same way that, in my experience at least, they don't think about things in the same way as a carrier or a broker will, because transportation is not their core business. What they're trying to do is just maintain a semblance of the operation, stay within budget on the transportation cost side. They're not going to jump out of their contracts just to save 5 cents a mile on everyday freight. They're going to make sure that they're keeping their carriers in line. They want to make sure they're managed appropriately. So their spot market freight is simply drying up. That's kind of the anomaly freight that they don't really plan for. They don't have a contract for. That's drying up because they're trying to maintain their existing carrier base. It's easier to manage that way. They don't want an extra 5 or 6 carriers in there bumping their docks every day. So there's going to be a lot more reliability on that end from the shippers and the carriers themselves that are in the contracted space.
Great. Thank you very much, Zach Strickland, for your time today.
Thank you, Zach.
Yeah. Very good. Very good.
And who we got up next?
We have Anthony Smith, our head economist, and we're going to talk about jobless claims. So, Anthony, jobless claims came out this morning. We do have a question from our good friend, our railroad guy, Jim Blaze.
Oh.
And we'll talk about jobless claims, and then that'll feed into this question. How soon I can't read today. How soon might we see data suggesting the drop in consumer discretionary income available to buy things beyond rent and food, medicines, and utilities, thus driving upturn in future freight demand? So we'll start with jobless claims and then migrate into that question.
Hi, guys. Thanks for having me. There's a lot in that question, and so a lot to unwrap. And as you mentioned, jobless claims did come out just this morning. What we saw was an increase of about 4.4 million overall. So the number of claims are coming down, but it's still important to remember that these are initial claims. So we have to add on to the initial claims that were received over the last few weeks. And when we do that, we see that there's well over 20 million, so I think somewhere around 26.5 million Americans that have filed for unemployment benefits over the last 5 weeks. And so that's a substantial number and really the highest number that we've seen ever, of course, but it really erases all the gains that we've had since the 08-09 recession.
So, Anthony, let me ask you this question. Maybe you have this answer, maybe you don't, but 26 million over the last 5 weeks. What percentage of the workforce is that, to put it in perspective? I mean, 26 million is a number, and it's huge, but do we know what that is? Is it an extra 10%, 5%?
Yeah, well over that 10% mark. We're getting there. Depending on which numbers you're looking at, it's going to start to get into the estimates around 15. Some are saying upwards of 20% is feasible. I haven't checked to see because these numbers do get revised on a week-to-week basis. So there's a few departments that you'll have to fact-check on each other. But it's safe to say that we could see likely to see double-digit unemployment numbers anywhere within that 15 to 20% range.
I think what's interesting to me, I'm sorry, go ahead.
It'll be an interesting May unemployment number that comes out.
It will. I was going to say it's interesting to see that we're watching volumes, which shows you what the economy is doing, just drop off a cliff, and now they're starting to sputter, right? And you're seeing jobless claims that were 7 million in 1 week, wasn't it, at one time?
6.8, I think.
6.8 was the high,
yeah.
And so the number of new ones, absolutely horrible, but that number is shrinking. Each week.
It is. Anthony, any color about state by state, which states are being hit the hardest?
Right. So when we're looking at a state-by-state basis, this is going to be really important, especially as we're looking on the headlines and we're seeing that certain states are looking to start to initially slowly reopen. And so, of course, as expected, the Northeast getting hit hard. To kind of go back a little bit to that initial question, when we're looking at jobless claims, this is one of the numbers and one of the areas that we were really kind of pointing out even before the coronavirus pandemic. And so this was a measure that we monitor closely just from internal due diligence standpoint to seeing engaging the workforce economy. But now it's really been ramped up. I think one of the areas that people aren't going to be paying attention to too much, that I'd like to draw your attention on, are continued claims. And so that's going to be an area to watch closely, because this is really going to see what kind of recovery is really put in place on a state-by-state basis. So of course, Northeast getting hit hard, New York, Maine, Connecticut, all throughout New England, getting really the worst of it right now. But when we're looking at the Midwest, when we're looking at the Southeast, they're really kind of leading the charge on looking to reopen. Of course, as we see all over the headlines from a lot of individuals that are looking to just kind of get right back out there, hoping to get back into the workforce. But when we're looking at the economy and the recovery and what's happening on the consumer side, it's going to be really important to look at the same release, which puts out, the U.S. Labor Department puts out the weekly jobs claims, but to start looking at continued claims, looking at those individuals that are continuing to apply for these unemployment benefits and are unable to find work. And so when you're looking at those individuals that are applying for a continued a lot of time, a week-by-week basis, that's really going to tell you, okay, is this starting to alleviate or not? Just because the number of claims are coming down, how many individuals are still continuing to apply on a week-by-week basis?
When do you think, going back to Jim Blaze, I think you answered it a little bit right there, when's the next round of really good consumer sentiment data and spending on discretionary items? I know that these last reports were kind of done right at the beginning of the sharp slowdown and the lockdowns.
Right.
What do you think about next month?
Right. So I think when we're looking at the latest data points, when we're looking at consumer sentiment, a lot of those, especially looking at March, is such a strange month, right? You know, from the beginning of March, we talk about all the time, to mid-March to the end of March, there was a completely drastic landscape throughout that entire month. Some say it was the longest month of ever, but when we're looking at it, there were a lot of variances. And so when we're looking at April, that's going to give us a little bit more insights into what consumers are feeling on the outlook side of things. Because as of now, especially when we're looking at, of course, the consumer sentiment, we're looking at consumer confidence by University of Michigan and the Conference Board, they're all kind of painting that bleak outlook right now. I think one of the other underestimated sentiment measures, the Home Purchasing Sentiment Index, shows that consumers are down in the dumps right now. When we're looking at the obligations that they're really feeling the biggest burden under, is going to be, of course, as we just mentioned, their outlook for employment availability, or their ability to maintain or keep or even grow their current income levels. And so knowing that this is going to be on the forefront of people's minds, it's going to be really the pivotal point on where and how we progress. Of course, a lot of that's going to come down to how the containment for the coronavirus really unfolds, and really if there's any kind of vaccine developed, testing measures, and tracking and methods like that. That's really going to kind of dictate, I'm sure, where certain governments and local, I should say local cities and areas like that really decide to open up and really kind of ramp up activity again.
Excellent, Anthony. You know, on freight forecasting last week, we were talking about leading indicators to look at moving out of this. And you had non-defense capital goods, and I believe it was new production orders, right?
That's correct.
When do those come out next?
Yeah, so we are looking for new orders to come out later on this week, so we get a little bit of a refresher for non-defense capital goods new orders. And so that's going to be a really good indicator to watch. As you mentioned, that's going to give us insight into what's happening on the business-to-business front. We're looking at, of course, stripping out that defense side of things, because that can, of course, sway greatly from month to month depending on what's happening, and they're not very predictable. They're very much volatile. So when we're looking at core essential business-to-business activity, business investment, that's going to be a really, really key indicator to watch, along with PMI, the ISM Purchasing Managers Index new orders specifically, because of course we have production. But looking at those new orders really is going to tell us what's happening down the line, and of course that's going to be coming up here in a couple of weeks as well.
Thank you,
Excellent.
Anthony Smith. As always, great insights on the economy. Having our lead economist there at FreightWaves, Anthony Smith.
Excellent job. Thank you,
And
Anthony.
I think we have our next guest.
We do. So we're bringing on
joining us from
Andy Berke, Principal and Senior Director of Strategic Ventures at Bluegrace. Did I get that right, Andy?
You did. Good to join you guys. Thank you.
Yeah, it's good to see you. I've known Andy for a number of years, done business with him for a number of years. And tell us a little bit about Bluegrace, where you guys started, what you guys do.
Well, we actually started in the last recession in 2009, kind of scrapped together some of the top LTL minds in the business and figured out some technology to be able to leverage some pretty fantastic growth in the first part of this decade. And what we're faced with again today are some challenges that are not too dissimilar from when we started. And it really takes creativity and an experienced team that fortunately we have to try to be flexible and work in the situation. So I'm happy to be here and talk about the current situation and what we're doing, what I'm seeing. And you guys are providing a fantastic resource for some economic data that all in one place.
I appreciate that, Andy, and thanks for coming on. So, how have you guys been dealing with it? The work from home and everything there at Bluegrace. You got most of the people out of the office, or how are you guys dealing with it?
We do. We've kind of left it up to the individuals to stay home if they like. But what we weren't a big work at home company before this, but we're pleasantly surprised with the productivity. The outcome has been very positive, both from the flexibility for the employees to be able to be with their families, the kids that are home from school, and yet still be able to contribute in a really outstanding way. So pretty happy about that. And we're seeing really good results from it. So my guess is as we move forward out of this stage, we'll have a little more flexibility on the work from home side.
Yeah, we've been hearing that from a number of folks that are going through this experiment, that they've been pleasantly surprised with the productivity and the results of the work from home, and that it'll probably, at least a portion of it, will stick as they move forward.
Yeah, and it's been a little bit of a challenge because in the process, right as the coronavirus hit, we decided to move forward on an acquisition, of Anthem Logistics, which has been it's a really good fit for us with similar innovative culture, increasing our capabilities in truckload on the reefer side, veteran personnel, and really matching locations so we can probably consolidate some of the offices and some of the locations. But the integration has been a little bit of a challenge for us over the last couple of weeks, just because there's no centralized place for training to happen, for culture to blend together. But it's been really positive and creative. It's just for us that's our main challenge, along with keeping our customers happy and making sure that the folks that are good shippers can pay and stay good shippers.
That's fantastic, Andy.
Yeah, and it's interesting that I mean, Andy, you're going through this time where it's uncertain economically and the viability. I'm not questioning the viability of Bluegrace Logistics at all, but you don't know where the economy is going, right? You're not certain if we're at the bottom or so. And you guys went out and you had this acquisition going on. You went forward with it, but then, like you said, integrating when you do an acquisition is a really painful, tough thing to do in a normal economy. And now you've got one where you're trying to integrate and bring everybody together, but they have to stay 6 feet away.
Or at home.
Which
right.
makes it a little more difficult. So I'm sure you're having some challenges.
Yeah, little hiccups, but everybody's been really great because, I think the two teams were pretty synergistic already going into it. And so we have pretty clear goals and pretty a clear path to be able to get everybody on board and on the same systems, running in the same direction.
So, Andy, this is Kevin. What's your take on M&A activity for the industry, whether it's freight brokers, 3PL, trucking for the remainder of the year?
Well, I think really it's going to first depend on the capital that is accessible to different providers. But I think that it's not going to be uniform. It's really going to be opportunistic, where there's going to be really good fits. There's going to be some distress situations where if companies are well positioned, it can be a win-win on all sides, right? So I think in this economy, we're going to see quite a few more shippers keeping their doors closed, bankruptcies. It's going to flow through the channel and through the supply chain, and it may be a hit for some of the brokers and some of the transportation companies that we're accustomed to. As that happens, there will be some shakeout and some fallout. But I think the better companies are going to be able to form partnerships, they're going to form links to capital, and be able to make it through. But I think it's not going to be all ships in a rising tide. It's really going to be unique to each company and how their cash flow and how their customer base and the segments that they serve.
I would imagine the valuation, company valuation outlook right now is a completely different world than it was whenever you're evaluating your acquisition back. Probably it closed in mid-February, I think. So back in January or earlier this year.
Yeah, the idea of going for a multiple versus prioritizing cash flow has definitely shifted, right? So the idea of some future state where there's a multiple that we're going for, that is prioritized less and really more cash flow in the next year or two of any type of acquisition really has to be looked at as one of the primary factors.
Yeah, Andy, I wanted to ask you this about the market. So Blue Grace has a significant percentage that in your brokerage that is less than truckload or LTL, correct?
Yes, correct.
So what are you seeing on that end?
Yeah, on that end, it's a mixed bag. Some of the LTL carriers are getting hit pretty bad. There are some that are taking the strategies of trying to grow market share with growing. Trying to fill the capacity that they have with lower pricing or more aggressive, and others are taking the opposite road where they're trying to grow margin dollars by increasing rates with customers that they have. And so we're not seeing a uniform strategy there. But we're seeing the LTL shippers, by and large, the larger shippers that are shipping LTL and truckload, the companies that are shut down, obviously there's a missing piece there, but the ones that are shipping typically are shipping. The replenishments are more frequent. There's more urgency to get freight through the supply chain. So, on balance, things are pretty full, and we're seeing quite a bit of companies now looking for more the data, the intelligence to find the efficiencies that maybe they didn't have time to look at before.
Very good.
So one of the things, Andy, to kind of follow up that we talked about earlier in the week was tender lead time is something that we track here through SONAR here at FreightWaves, and it's the number of days between when a load is tendered to a carrier when the pickup date is. And typically when volumes rise, that shrinks as shippers are falling out of the routing guide. They've offered a load for 3 days out, then they fall out of the routing guide the next day. Now it's a 2-day tender lead time, and things change. But the tender lead time has risen. And one of the theories, or one of the things that we're thinking about is, are those shippers now holding on to those smaller orders to fill that truck capacity because the urgency in most goods just isn't there anymore, right? The expectation of the consumer, the Amazon effect, if you will, and I need it in 2 hours, it's just not happening. Amazon said Prime is suspended. That 2-day could be 3 weeks. We don't know. You'll get it in a week or 3 weeks or whatever it happens to be. So typically LTL, when truckload volumes start to decrease, you start to see more spot market volume contracts, right? And LTL kind of increases. Are you seeing that effect or not?
It's a mixed bag. Like I wish I could say yes, there's a clear shot going one way, but it's not. We're seeing it's almost by industry.
Yeah.
It's segmented even by customer within the industry. We're and even the Amazon effect that you mentioned that may be not happening, where Prime is kind of pushing back their prioritization for deliveries. We work with some final mile companies, and there are some that are looking for business, and there are some that are 400% growth.
Wow.
In the past 3 months, and it really depends on who their customer base is. It's not necessarily the mode itself, if that makes sense.
Yeah, it does. It does.
It does. So we have a Facebook comment again from an owner-operator saying that he's been parked for 3 weeks because of the rates, and that's from Mike Posey, which brings me to the full truckload sector that you guys have at Blue Rates. And is this something that you're seeing? You're seeing that the smaller carriers, the owner-operators, leaving the market right now, maybe parking their trucks because of the spot rates?
Yeah, I mean, the spot rates have taken a dive, and then the fluctuation is definitely a challenge for the smaller players. When you keep in mind that the flow of volume that they have to choose from is smaller, and so if there isn't something that fits their particular needs, it may be the right choice for them to sit out and wait for a more profitable load for them. The larger companies really can orchestrate that differently and manage their resources, a little bit in a more complex way. But with the individual drivers, in this market, you have to be picky.
Yeah. So, Andy, the debate keeps going on. Are we at the bottom? Are we bouncing along a bottom? How much further down can it go? Imports have been trending up over the last month, but it's the last hurrah. These are orders from 40 days ago, and that's going to fall off a cliff. And then what does it look like moving forward? Do you have any thoughts on, are we at the bottom? Are we bouncing along? Do you expect it to drop a lot? I mean, I'm not asking you, nobody really knows, but what's the sentiment?
Well, the sentiment is, we're getting a sense that there are some customers that are talking about reopening. So, there are some big companies that we've heard are targeting the first week of May for reopen. There are some, others that really are, on lockdown for a much longer time. I think that flows through the supply chain to the inventories, and even orders that were made 30, 40 days ago and now are hitting the container freight stations, and then looking at storage and trying to move throughout the U.S. The challenge there is if the orders can't be received, then there's a storage issue, kind of like oil had a storage issue a couple days ago when the expiration hit, and went negative because people had to pay for storage, and it's just not being used. I don't see that as extreme in the freight market, but you're going to have, again, a segment of customers that ordered and can't receive what they're getting, and so now you've got storage issues, you've got delivery issues, and it kind of ripples throughout. I think until we get a clear path from governors, from the government, to be able to say, here's how we can stage a reopening in a very clear path across multiple states, you're going to have a spotty up and down situation depending on industry. And I know I keep going back to that, but we're really seeing a night and day depending on industry and company. So I think that the risk that we run is when second quarter financials come out and, the possibility of a wave of bankruptcies. We already have companies that aren't paying leases. We have companies that are warning. When we see this economic hit, the stock market and the general market doesn't seem to be factoring that in on a long-term basis. And, for a shuttered group of companies that's going to reopen and we're going to have a V recovery, it's not a big deal. When it starts to get where there's not these companies aren't going to recover and there are increasing bankruptcies, then it does impact for the longer term, and it will impact the general market. So I don't know. My look is I'm cautiously optimistic that if we can reopen, even a staged reopening over the next 3-4 months, that we'll get back to some semblance of normal. If it really drags on, we're going to see a wave of bankruptcies and disruptions all the way through the supply chain.
And then that's something that the transportation companies of all aspects really need to identify. That risk is the accounts receivable risks with those bankruptcies through small businesses and some other businesses that certainly might slow pay or not pay at all and might declare bankruptcy. That's a real risk out there right now.
It is. There's a much bigger focus on credit, accounts receivable, collections, and on the front end, really ensuring any new business has the right relationship in place to be able to, get credit or get the ability to have an open line of shipping.
Excellent, Andy. Thank you so much for being on today, my friend. Highly insightful. Hope to have you on again very, very soon. And I'm just going to point out that I invited him on What the Truck for Monday, but he declined because they're opening the beaches down there Monday. Is that right, Andy? You're taking a day off.
That's right. It's hard to understand what the Florida governor has in mind, but this is one of the good points that we're going to roll with. And the beaches are open, I think, for exercise and walking, I think is how it's been described this coming Monday. So
you're going to go out there and do some push-ups and sit-ups, get your crunches in on the beach next week?
Anything to get fresh air and to get, the family outside. So
yeah, amen.
It's agenda.
Thanks a lot, Andy. Have a great day, my friend.
All right. Take care, guys. Thank you.
Thank you.
Interesting insights what those guys are doing, and I mean, how difficult would it be to go through a merging of two companies right now?
Yeah, I know you're joining two different cultures, right? And integration is always the challenging part of a merger and acquisition. To have that everyone distant and remote.
Yeah.
It'll be a business school case study. It definitely will.
It definitely will. Hopefully they take good notes.
Maybe never been done.
So let's talk about what's in SONAR.
Let's do it. Where are truckload volumes, Michael Vincent?
So truckload volumes kind of rebound's a strong word. That's what I wrote in my notes as rebound. Slight rebound. So they were at 85.31 and they rebounded back to 86.46, appearing like they're kind of recovering or kind of normalizing. I hate that word, but from the Easter weekend,
the floor, right?
From the Easter weekend, and then they dropped, and there was that uptick that was like the week over week from the holiday, and now we're well past that, and it's showing this strength. So it would kind of show that we're bouncing along some type of floor.
It does. We're stringing consecutive days along that, which is good news for everyone. A viewer comment that we didn't get to is Ruby again, and she just wants to make sure that, and here's her comment. Owner-ops seem to think brokers are being greedy and keeping high profit margins. Please make it clear to them that this isn't the case. And we can do that. It's not normally the case, right?
Yeah, those loads that were paying $1,700 to Odessa out of Houston that are now paying $700. The shippers aren't paying the broker $1,700.
They are not.
Either.
It's as close to as free market as you can get is the trucking market, especially the spot market for trucking. And when loads are down in the 8,600 range, rates are going to drop. and there's not much you can do about that because it's a market clearing price.
Yeah, and when you look at what Noel Perry was saying, right? If we bounce along this 8,500, right? It's not going to take for us if it unfortunately, and hopefully it doesn't, but if it comes to fruition that a bunch of trucks are parked and they don't come back on and we lose 50% of the capacity or 20% of the capacity, it's not going to take record levels of outbound tender volumes like we saw in March of 12 and higher.
Yeah.
12, 9,300, 9,400 could see rejections spike through the roof and hit the rates up.
Yeah, if you just return to 2019 levels, it would be a huge spike from this level. And on Facebook, Mike Barnes says, great segment. Thanks, Andy. So thanks again to Andy.
Andy's got a
He's
fan.
got a fan.
So the other thing that we're seeing is that tender rejections, even though we had this uptick, right? Tender rejections, and we talked to Zach a little bit earlier, our director of freight market research earlier on the show, 3.13, 3.14 is where rejections are all-time low.
They
which
are
will tell you
all-time
there's
low.
zero pressure for rates to go up. There's not even pressure to keep rates where they are right now.
That is, and I think, and Andy was talking about it, is that you have a lot of your customers who are probably having trouble paying their bills and they're looking to cut costs, and part of that is going to be shipping.
Yeah.
And it's just one of these negative feedback loops that economies see. James Warner, regional manager of support, and it cut off on there, but food sector to consumer has increased, but food sector to warehousing or wholesaling because of restaurants, casino buffets, restaurants, those wholesale markets has not. So I don't know how that evens out, or even if it does.
I'm sorry about that. The laugh was because the whole Vegas mayor thing.
Oh, the Vegas mayor, yes, yeah.
And if you haven't seen that interview, it's hilarious. But no doubt. I mean, it is. Yeah, right. Food to consumer, absolutely. Food to restaurant supplier, not so much.
Not so much.
And probably, well, hopefully it's going to start to pick up here. I mean, we've got some states like Georgia's looking at, restaurants open and so on. It would be some of the first things, right?
Brings us back to the meat supply, too.
Yeah.
And the processing plants that are now closed down, which takes loads to and fro out of the picture. So Jabber JB Smith at Commercial Transportation responds to Ruby. It would be more beneficial if they would pay attention to the volumes as well as the rates, and that's kind of what we just talked about. You have low volumes, you're going to have low rates.
You have to, and to
physics.
To go into SONAR a little bit more about like what's happening here, and we talking to Anthony earlier, I brought up the IPROG and the non-defense capital goods spending and so on, because we went through those. You got to be looking at those economic indicators to see if the economy's coming back on, and there's plenty more.
Well, that's going to tell you demand.
You got to look at those,
right?
yes. But when you're looking at if you're just looking for load today and looking for best rates today, rates are not good anywhere.
No,
right now.
no.
They might be a little bit stronger in one market than another, but they're not that great.
You're going to see anomalies.
But
yes.
I mean, you look at Ontario, California, right? In Ontario, California, 14.4% uptick in volumes, which is strong.
It is
strong head haul move. It's a head haul market anyways. There's more outbound than inbound. But it had, in the market volatility table, a strong move towards head haul of 38.9%. It was all driven by van, regardless.
Yeah.
It was a strong move, but rejections are still sitting at 2.28.
Yeah, I was looking at Allentown, PA, and they had 6.17, 6.18% yesterday.
Yeah.
Still kind of a strong market. And you're going to see, each individual, we have 135 freight markets in SONAR. Each of these are individual kind of economic systems. They're importers and exporters, and you have a balance of trucks in the market and loads in the market. And even with depressed loads, you might not see the trucks entering the market in enough volume to keep spot actually it would push spot rates up, so you're going to have these day-to-day fluctuations, and you just need real-time data or as near real-time as you can get
to
be able to identify these and plan.
Yeah, and that's the point. And you're going to find those nuggets like, so Joliet had a 4.2% increase in outbound, Joliet, Illinois, in outbound volume, which isn't huge, right? But, I mean, it was an increase, and it was driven primarily by a dry van, and because reefer was fairly flat. But the rejection rate went up 8.6% and in dry van and 7.4% overall because it actually dropped a little bit in reefer. So there's a little bit of upward pressure there.
Yeah, there
8.6% is getting near that 10% where there's upward pressure in those rejections. Yeah. Now that may not happen for the next for over the next week. But that's why you need daily information as to what's going on.
Yeah, definitely. And Mike Posey says this as well. I'm finding in my hotshot business that full loads are being shipped as partials, even though the full loads fill the trailer. Which I guess is just cutting back costs. And then Faith Duman, who's a truck driver.
So they're chopping up a full load into 4 smaller loads?
I think so.
Huh?
I think so.
Interesting.
Faith Duman, who's a truck driver, responding back to Emily, it can be said that there is not just a surge in food sector, in product care. So I guess that's probably those essential consumer
like
packaged goods. Yeah, product care and things like that is what I think it is. But let's move on to the good news. We're wrapping up the show here. Let's talk about some good news.
You want me to go into that good news? Canadian
I do,
trucker
yes.
Nicole Fults, who will be on What the Truck tomorrow, is raising money to get fellow drivers face masks as she recovers from the suspected COVID-19 infection. Fults, who is only 26, launched a GoFundMe campaign. She didn't launch the actual GoFundMe. She launched a GoFundMe campaign after hearing from drivers who read the FreightWaves articles about her experience getting seriously ill while on the road. I got a huge flood of messages. A lot of drivers say they don't have masks. And she's been, she told us that, she was quarantined in a hotel by the Canadian government. Right, this is the one who was coming through, and she was in South Carolina. By the time she got to Pittsburgh, she had a fever of 102 and so on and so forth. By the time she got back to Canada, she had to have oxygen and all this kind of stuff. So she's improving, which is great news, and we'll talk to her and see how we can help get people to help fund this. And
Monday on FreightWaves TV, right, and you can download the podcast or go to the FreightWaves and watch this. You guys had an incredible interview on What the Truck.
Yeah.
With the gentleman from BNSF Railway about his
13 days in coma.
13 days, yeah. Intubated on a ventilator, and just that experience. So go back and you can re-watch that on video at FreightWaves TV or Apple Podcasts.
It'll make you rethink social distancing.
It will. It will put a scare in you, definitely.
43-year-old guy.
43-year-olds, yes.
Knocked him on his butt.
I know, for a long time.
Yeah, it really did.
Later today, we have freight forecasting.
We do. And
at
I'm going to
4 o'clock.
Yep, 4 o'clock. And I'm going to have Greg Miller on, who's our senior editor, Maritime at FreightWaves, and Zach Strickland, our director of freight market intelligence. Man, he's getting a lot of air today. But we'll be discussing the maritime imports, how they affect the freight market, surface transportation, et cetera. But also his article in which he's talking about, this import run-up. It's the last hurrah. Things are going to drop off a cliff.
Yeah, I think it's tied to demand in the U.S., right? So very good. This past Tuesday, we did Great Quarter Guys. We talked about earnings seasons in full swing. So we did 30 minutes of in-depth earnings previews. Wednesday, put that coffee down. The market is sliding, especially on the rate side.
Yeah.
And we talk about how not to slide into that price trap, how to create a premium service for yourself, and how to put that system in place. And then we had Freightonomics, which I think they talked about earnings as well, the Knight Swift earnings specifically. Right. And then we had with SONAR yesterday afternoon. So you can watch all of those on FreightWaves TV. You can download the podcast on Apple Podcasts as well.
Right, and don't forget What the Truck tomorrow.
I'm finishing with the good stuff, right?
Yeah, leaving the best for last.
Do you guys have an agenda
What
set?
the Truck? Well, we'll be talking about truckers versus brokers and the battle of the bottoming spot market.
Yeah,
truckers versus brokers.
So everyone out there watching that's interested in this battle of the rates, watch What the Truck tomorrow at noon Eastern time. So every day of the week we have something at noon Eastern time. Monday and Fridays it's What the Truck. Tuesdays and Thursdays it's the coronavirus freight market update, which is us right here. Wednesday is the Freight Sales Podcast. Put that coffee down.
And the other important time in the week is 4 o'clock on Thursdays.
It is.
Freight forecasting.
And I think at 3 o'clock on Wednesdays is with SONAR.
That's right.
I
Another
think
good
it's 3
show.
o'clock
Great
these
show
days.
yesterday, by the
or
way.
4. I'm sorry, it's 4 o'clock.
Yeah, they had a great show yesterday, too.
It was a really great show.
Yeah,
But
check
that
that one out.
wraps it up for this episode of the Coronavirus Freight Market Update. Thanks for joining us.